Hey, Brent, it's good to see you. Today, we're talking about how emotional investing can be costly. We are still firmly in bear market territory. Of course, fresh off the midterm elections, we knew there was going to be a lot of volatility. Stocks and bonds are negative, and the market has lost nearly 16% since the beginning of the year. I want to show you this chart from FinViz, which is the S&P for the past year. We see a lot of red, a lot of green, though, but when I see this much red, it makes me feel pretty anxious.
Yeah, and I think a lot of people are feeling the same way. It's been a roller coaster. We've seen, a lot of up and down, mostly down this year, and so that causes people to consider making knee-jerk reactions. So we try to remind people that this is normal. It's not fun, but it is normal, and that to stay the course with your investment plan. We put a written plan in place for a reason, and very rarely are we going to, recommend a major change just because we're having a down year.
And the reason that you have that written plan is so that we don't react emotionally, right? This is the investing cycle of emotions, Brent. And as we zoom in here on maybe the lower point of our feelings, where do you think we are here?
That's a good question. We're getting down pretty towards the bottom, if not. We just saw a big jump
Hmm.
due to CPI numbers. So could that be the swing to push us towards optimism? I don't know. But that's the good thing about not worrying about trying to time the market. And we put people on automated plans. And if you just stay the course, we could speculate all day, but it doesn't really matter because things are automated.
Hmm. I'm glad you mentioned that recent bump that we saw in the markets after the CPI numbers were released, because this chart helps kind of bring it home for me. I just want to remind everybody watching that you and Kim are backed by a team of investment experts at Brookstone Capital Management. This is from our CIO, Mark Diorio, who crunched the numbers. This is a $10,000 investment over a 15-year period. If you stay fully invested, that's the bar on the left. But if you miss just the 10 best days, look what happens.
Yes, exactly. So this is a great refresher on why you should not try to time the market,
Hmm.
because you don't have to be very wrong for it to cause major implications. The other thing to keep in mind is that as electronic trading has come over the last couple of decades, it has made the ups and downs more dramatic and quicker. And so that's why when you try to, okay, I'll just pull out for a little bit, by the time you try to get back on that train, you may have already missed some of those best days. And you can see how dramatic that is on an
Yeah.
investment portfolio.
Right. That really does put it in stark perspective. So I know you are a financial expert in your neighborhood. I'm sure there's a lot of people who stop you in the grocery store. What's the most common question you're hearing right now?
Yeah, to be honest, one of the most common ones is, should I pull out? Should I sit on the sidelines and wait till things calm down? And or another one is, should I stop investing until things get better? And the answer usually is, well, come in and let's talk about it. But
Hmm.
the broad answer is no, you shouldn't be sitting out on the sidelines. If your allocations are correct and your plan is automated, dollar cost averaging, keep putting that money in there, stay the course, because a lot of investors are just using their 401ks or other type of retirement plans and trying to guess when it'll come back. Like I said earlier, you don't want to miss that big swing up because it will eventually come. It always does.
Hmm. You're also known for helping people solve complex financial problems. So what should we be keeping in mind right now?
Yeah, good question. So there is a lot of pre-retirees that we talk to, and they've been sitting on the sideline, to be honest, concerned or terrified. And it's because they're just about to retire, and then now the things are swinging in the wrong direction. And so they're thinking, oh, this is not good. I need to sit tight and wait for it to end. That may not be the case, depending on what they're involved or what they're invested in and what their financial situation is like. So thinking that you need to sit on the sidelines and wait for a full recovery, if you're, in that 62 to 65 range where you're trying to get retired, that's not the case. It's a good time now as ever to come in and talk to a professional and see if, you can come up with a game plan to get you retired.
If nothing else, it helps just to talk to somebody like you, because again, you have this information which makes us feel, or makes me feel, a little bit less
Right.
anxious as opposed to just sitting it out entirely, right?
Oh, half the time it's literally just telling somebody you're not nearly as bad off as you think you are. And that
Yeah.
immediately boosts morale. So that's
Yeah.
that's a good part of the job.
All right. So Brent, if somebody does want to have that conversation with you, what's the best way to reach you?
Yep, they can call the office 614-430-8383 or go to the website. You can make an inquiry there, and that's www.young-wm.com. We're
All right.
available.
Brent, thank you.
Thanks.